The biggest risk factor is human
Mm-hmm.
nature over the insurance company because it's not free money. You have to be honest and pay it back. But if you decided to get into the business of banking, you should be surrounding yourself with other bankers and you should be surrounding yourself with the knowledge. It's not a one and done and it's all going to work out and be just sunshine and roses. Hello, 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 and welcome back to the podcast. Thank you very much for being here. Okay, we're going to talk about use it or lose it. So if you have BYOB, you should probably dig it out and read this chapter. And then you can review, you can come back and listen, or you can listen and then review. I guess I don't really frankly care. But you should have Nelson's book. And if you don't, why? Anyway, okay, let's get into use it or lose it. Tarisa has a story. I have lots of stories. What's your story? Let's share.
Let's do it.
What are you thinking?
Okay, so this is super relevant because I had some clients come to me and they're like, hey, Tarisa, we're not sure about keeping our policy. Keep in mind, these people have a ton of cash value inside of their policies. However, they've never used it. They've never used their policy. And I think about this a lot like spring cleaning. It's like, if you haven't touched it in a year, throw it out, And people kind of do this in springtime. They're trying to purge the things that don't serve them.
But this is that roaster. This is the roaster that you need for Thanksgiving, people. This is not a blender you never use.
Right.
Okay.
Yeah. Well, here's the thing. My policy, I view it as a fork. I'm making sure that I'm in touch with that thing almost every single day, every single month. But for some people, it is the unused toaster. And it's not because it doesn't have fork quality. It's because they're just not using it. They're not using the fork. I don't know. Maybe you're a spoon person. It's not really efficient, in my opinion, with getting stuff into your mouth. But anyways, I'm super weird with how I think about things.
But let's separate you for a minute because you and I eat, sleep, and breathe infinite banking. Okay. So we are going to use it differently than our clients who act like it is that kitchen gadget that we never use. Like, why did we buy this stupid thing? So you are 100% right. They forgot why they had it, even though it's there and it's a tool that can really do some awesome things, right? Like, okay, we have let's just say it's a bread maker. Okay. So we've got this bread maker machine that we forgot we had. It's there, but we're going out and buying bread all the time. Just like going to the bank, right? We're going to the bank and we're borrowing money to buy cars and do all the things, but we could just make our own bread.
Right. Yeah, I like this topic because it really comes down to mindset and just being intentional about using the thing that you are putting a substantial amount of money into, because I think you're right. You and I, we eat, sleep, and breathe infinite banking because I had this conversation with another agent and I just was like, I've never, not once in my entire existence, thought I need to cancel my policies. I've never once had that thought. But I know for a lot of people, that's not the case. And so I think this podcast is for someone who is like, why am I using this thing? Why did I buy this thing? So to kind of circle back around to this story, they have quite a bit of money in cash value. They haven't used their policies. They've been great about paying their premiums, but they don't see the value in it because they haven't necessarily used it yet. So I took the time to figure out, okay, what is this person trying to accomplish? Well, it turns out they're planning to save. They have a rental property. They want to pay it down in 5 years. So they're allocating around $1,200 extra per month to pay that down sooner. And so what I did, because I'm a nerd, is I am taking this idea and showing them, hey, if you put that amount of money instead of in your savings account inside of your policy and actually use it in the way that it's intended, you can have access to that extra equity all along the way. And still, if you want to, pay that property off in 5 years. But the difference is, where are you housing that money, right? It's not an either or thing. It's an and thing. So I think it's really important to talk about, okay, well, how can this concept go wrong? And I think one of the things that's very prevalent is if you don't use your policy, because you're not going to see as much value in it as someone who's actively using it.
And if you don't use your policy, you don't have enough premium being paid.
That's a good point.
If you never have to go to your policy, you're not paying enough premium. And if you're not needing it for anything, you're putting peanuts in and you're only going to get peanuts out, right? So there's a couple of things there that were those people taking this $1,200 a month and actually putting it on the mortgage.
That's their plan. And I'm basically going to show them conceptually why it would benefit.
So they're sitting on an extra $1,200.
Oh, 100%. Yeah, their issue is not lack of income for sure. It's they want to have the property cash flow more, but the mortgage on their property is only 3.5%. So in my mind, I'm like, you guys are very smart, savvy business people. Can you make more than 3.5% with an extra $1,200 a month, which is what, for a little more than $14,000 a year?
Mm-hmm.
Probably.
And if we have and it's a rental property. So obviously we're in the business of renting. So that $1,200 a month can go back in, that can do multiple things. It can go into a policy and you can use it from there to buy another rental property that would create more cash flow. So if we're in the game of rental properties, it's all about creating cash flow. So do we want just one and we want to pay it down so it makes us feel good? Because it's really comes down to a matter of feeling good and numbers.
Mm-hmm.
So does it make us feel cozy to have it paid off, but it's only 3.5% interest? So why would I pay something off that's 3.5%? And then when I need it, I'm going to go back to borrow it at 7%.
Right.
Because that's what they're going to pay. That's what they're going to charge me, is 7%.
Mm-hmm.
If you put the $1,200 a month into a policy and you need it because you don't have renters and you've got 6 months without renters, well, now you can borrow money from the policy to make your payments because you have opportunity, because you have liquid money. So why are we paying off a 3.5% mortgage? A lot of people, and it's funny because people will say, well, oh my gosh, what happens if the company goes under? That is their number one concern when they hear about infinite banking, is what happens if the company fails? More likely, human nature will cause this to fail than an insurance company failing. Human nature is, I'm going to buy it, I'm not going to use it, and we're going to end up with use it or lose it. Because if we don't use it, we lose it. And we forget why we're doing it. If you look at Nelson's book, he talks about the fact that you need to surround yourself with people that are doing infinite banking. If all you do is buy a policy and then you surround yourself with financial advisors, you're going to cancel the policy because some financial advisor is going to tell you it's a horrible idea, but they don't even understand that it's an and asset, not an or asset, right? There's the noise of everything going on around you is going to make you lose it. And so I have this exact same thing happening. I had it happen this last week with a client. She came into a meeting. We're, 4 years into this policy. And she came into the meeting just upset. Well, I don't even know why we have this thing. It's just an expense every month and we don't have any money and I need a new washer and I don't have a deck on the house. And she was all mad. And I said, so I wasn't probably as nice as you and diplomatic. I said, well, why aren't you using it? I mean, if you're going to fire at me, I'm going to fire back. And I'm like, you have $38,000 of cash value. Why aren't you using it? Well, we just needed $250,000. 38's not enough. And so we started talking and she said, well, I just put 20,000 in a CD. I said, I thought you didn't have any money. And she's like, I said, where did that come from? Well, it was just excess money. I said, okay. So you have $20,000 in a CD, which should have gone into a life insurance policy. Mm-hmm. And I said, and you need a new deck and you need a washer. And you have plenty of money to put your deck on the house and a new washer because you got $38,000 sitting in cash value.
I'm like, how much is a deck?
Well, it depends what kind of deck you have.
Okay.
Ours was more than $38,000.
Oh, wow.
Maintenance-free decks are expensive. So I said, okay, here's the deal. It's not an issue of not having money. It's a mindset issue.
Right.
Because you are such a good saver, you act like you don't have any money. And your clients are probably in a very similar situation. They want to combine Dave Ramsey with IBC and Robert Kiyosaki, right? You can't do it. I tried it. This is how I know you can't do it, because you're not going to pay everything down and create cash flow. Like, you can't do Robert and Dave at the same time. So you have to look at the cash flow quadrant. You need to see where that cash flow is going through the system and how can we make more cash flow. Paying off a 3.5% note that you will probably never see again in your lifetime is not a good idea. The banks are hoping you think it's a good idea,
Right.
because they really want you to come back and lend you money at 7. And here's the thing. People may think we will see 3.5% again. My friends out there, I don't ever want to see a 3% loan rate for the sake of inflation. We have a massive problem in this country with inflation and printing of money because it was almost 0%. There was zero value added to it, and we just printed it like it was no big deal. Ink is never going to dry up. We ideally, if we have the right people in charge, which is probably never going to happen, if we have to get all the right people in charge of the economy, highly unlikely. However, if we ever see 3% again, 2%, 1%, we have massive inflation coming. And so that's why we're not seeing rates come back down, because it's going to be a problem. So
Yep.
There's my tangent on interest rates.
No, I think that's great. And I think for anyone listening, it allows you to think about the big picture. It's like, if you know that you have to use that dollar at some point, or you want the ability to use that dollar at some point, why would you go and lock it up in a mortgage with an interest rate at 3.5% just for the bank to turn around and sell it to you at 7 or 8, or whoever knows what the interest rate is? But the point is, you have to qualify for your own equity. Whereas if you put that difference inside of your life insurance policy, you don't have to qualify for it. So it's a fun challenge for me to reorient their thinking into, okay, why are we doing this in the first place? Here's the difference it makes over time. And like I said, I'm super nerdy and analytical, so I actually am putting numbers behind it for them to consider. So that's been fun. But it is true. It's like, if you don't use it, you lose it. So how this concept can go wrong: human nature, not having the right thinking about it. And some other tangible things are if they never pay back their loans. So if you're never paying back your loans or putting capital basically into your own banking system, it's just never going to be successful. You have to have discipline inside of this process. And that's the thing that I love so much about infinite banking, is it gives you 100% control, but also the same side of the coin is it gives you 100% responsibility. So if it goes south, that's because of you.
That's why the biggest risk factor is human nature over the insurance company.
Yeah.
Because it's not free money. You have to be honest and pay it back. But if you decided to get into the business of banking, you should be surrounding yourself with other bankers, and you should be surrounding yourself with the knowledge. It's not a one and done and it's all going to work out and be just sunshine and roses. And people think that. They're super excited right away to get started. They visit with us, we get them started, and then they forget about it because life happens. And I get that life happens. But if you're my client, there's MJ with coffee every other coffee with MJ. Well, I do have coffee too, so it's MJ with coffee.
It works both ways.
Yeah. So that's every other Thursday morning. Why aren't you there? If you're listening to this podcast, you're not probably the use it or lose it client. The use it or lose it client is not listening to the podcast, and they don't feel surrounded. Nelson didn't write the first half of Infinite Banking of BYOB. He didn't write the first half of Becoming Your Own Banker because he was bored and thought he should add a few pages to the book. He wrote it because it is human nature, and we have to get over some of these obstacles, and it's all about the way we think. And if we're thinking that this is an expense, it's going to be an expense.
Mm-hmm. Yep. And if you're not using it, right, it's like if you're not getting the utility out of it that you want to, it's also going to feel like an expense. Whereas like my mindset, and I do have to reorient my thinking less now that I'm further along the journey, because like I said, I'm super nerdy. I track how much my policies grow monthly, and it equates to passive, cash flow for me monthly. It grows
Mm-hmm.
just by me paying my premium. So I love my policies, but I think about it as a challenge of how much money can I flow through my policies as possible before I go purchase the investment property, before I go and, I don't know, do something that produces cash flow, before I go and make that loan to someone else that's paying me interest. Because if you can orient your thinking in that way, that you have the power to capture the earning potential of that dollar as long as you live, it very quickly becomes, okay, well, how much money can I fit in this thing? And how long can I pay this thing?
Mm-hmm.
Versus being like, oh man, my premium's coming up. It feels very different, right? Because
Right.
it is. But I use my policies
Yep.
for so many things.
And they're not all cash flowing things.
Right. They're not all cash flowing
So
things.
Tris and I talk a lot about cash flowing, using money for cash flow. And so then once in a while, I'll get a client that feels bad. They're like, oh, Mary Jo, I bought a vehicle with it. Or, I sent the kids to college with it. Or we put braces on the kids. It's okay. Because I'm not over here being judgy Judy, wondering what you're using your cash value for. It's none of my business. I frankly don't care. I do care. How come you're not paying that back?
Mm-hmm.
How come you're not paying the interest back? So occasionally I will hear about a client where we're like, oh, we're never paying interest, and I don't hear from the insurance company. We do cash value trackers as well for a lot of our clients, to where we're going to see that stuff's not getting paid back because we're looking at accounting to provide them information. But if I see that, I'm like, what are we doing? What are we doing? We're taking a loan every month. We're not paying anything back. This isn't free. So you don't need to use it for cash flowing asset, but you have access to use it, and it gives you opportunity. Putting $1,200 a month into a policy as premium and having the opportunity to use that as a payment if you're vacant, to go to Hawaii, to do whatever, I frankly don't care. If you are a business owner listening to this, I do not pay my quarterlies to the IRS. Absolutely not. And my accountant got really mad at me one time, and he's like, Mary Jo, you need to pay quarterlies. I said, I'm not paying quarterlies. Why would I give the IRS money that I can use for marketing to make more money? That's silly.
Mm-hmm.
So even your clients, what are we doing that maybe we don't want to buy another rental property? Maybe not. Maybe that $1,200 a month, maybe they end up with $10,000 in there, and they need to lend it to somebody, and they can make 9% on that money or 12% on that money. It gives us opportunity.
Absolutely. And opportunity to me equals freedom. It's like you don't have to ask for permission to get access to those dollars. And if you have an opportunity that comes across, your desk, you have the capital to take advantage of it. Whereas let's say you were allocating all of that extra money to paying off that rental sooner. Well, who do you have to go ask for money? Right. And then and then it's more expensive money.
But let's say that they're doing it to be cozy and all warm and cozy because it's paid off. And I get that. I like my stuff paid off, even my policy loans. But let's just say they're like, you know what? We've got this rental property. We're going to put that $1,200 there. So if one of us gets hurt and we can't work, we don't have to have so much. We don't owe so much on that mortgage, right? Well, if you put that money in a policy and you wait until cash value equals the mortgage payoff, if something happens, now you have the cash value to use as payments.
Mm-hmm.
Because if one of you gets hurt and you can't make the payment because it's vacant, then all of a sudden, what happens? You can't refinance it because you're going to refinance it at 7%. We talked about this in one of our previous podcasts. Liquidity of money is always going to be a better option, even if you're not using it to make more cash flow. that liquidity is always going to be a better option because of opportunity as a bailout or opportunity to make more money than if you give it to the bank and pay it down over time. Yes, you're going to save some interest. Did you figure out how much interest they would save on all your numbers if they paid it down early?
Not yet, because I'm doing like big picture. I use like the borrowing strategy calculator, but it's fun to see the difference. Like basically I figured, okay, the amount they're paying in premium now, if they were to just use that money in a savings account at the end of 30 years, it would be $573,000 roughly. And then at the end of their policy, it would be $955,000. So it's like without the withdrawal, just the same amount of money going into two different environments. And then if you subtract the amount that they're allocating towards their rental, the savings account went down to $422,000 and some change. And then obviously we never recommend withdrawing from a policy, but even if they did decide to do that, they would end up at $649,000. And then with infinite banking, the outcome is $1,121,971. So
the 1.1 million.
It's fun to see like, okay, what's the big picture? Well, the big picture is the input is the same. The input is a little over $500,000 in 30 years, but what's the outcome? Well, drastically different. Drastically different in their financial picture, but that's the fun thing. It's like, this is not an expense. It is an asset. It adds to your bottom line and it gives you all of the freedom and opportunity and access in the world that you need in order to be successful. We talked about if you don't use it, it becomes that feeling of it's an expense. Whereas I think you and I approach it as how much money can we get in these dang things so that it can grow for us forever so that we can use it for investing, use it for opportunity.
But it's all about the way you think.
It is.
And they're not thinking like bankers because they're not surrounding themselves like bankers. They're not using their bank, right? They own a grocery store, but they're going to Walmart to buy their groceries. And that's essentially what we're doing.
Yeah. Yep. I think to me, it's a reminder that if you're not in this every single day, you do need to surround yourself with people that are actively doing it. You do need, as a client, to ask your agent for strategies, right? It's like, I send out emails all the time to my clients, hey, take advantage of this strategy session with me. And it's like, we could have gone over this together, proactively, but that's okay, right? Life happens.
Right. Well, at least she answered your call.
Oh, yeah, for sure.
Kudos to her and kudos to my client. Even though she was a little bit irritated with it, at least she made the call.
Yes.
We have clients that don't make the call because the noise has got to them and they just cancel it. It could have been that option, which they could have absolutely lost. And then we feel bad because the client lost money.
Right. Yeah. And that's the thing. It's like, I want you to make an informed decision. Like, I'm never going to hold people where they don't want to be. But I'm like, okay, well, let me break this down for you as to why this is still a good idea and will still allow you to accomplish your goals. And I think that's the asset thinking that is required for you to be excited about putting money in your policies. I kind of lost my train of thought here, but yeah, I think, what other ways do you think that this can go wrong? Because I have another bullet point here that we can go over.
Well, let's hit that bullet point because we're coming up on 25 minutes.
Okay, let's do it. So the other one...
And people probably get sick of our 30-minute to 40-minute podcast.
Well...
Because we could go forever.
Well, it's our party line.
So let's hit her. Yeah.
This is our party line. This is how long our conversations are. But we'll keep it short for you. Okay, so this other bullet point is paying minimum premiums, right? If you're just paying like the base of your policy and the minimum paid up additions rider, and maybe there's a cost to EBIR, who knows, depending on how your policy is structured.
She's talking about term insurance.
Yeah, if you're paying your minimums and you're not taking advantage of how much opportunity you have to put in your paid up additions rider, that gives you access to the majority of that cash, you're also inherently not going to be nearly as excited about using your policy because you're not doing what Nelson says you need to do, which is capitalizing your bank. You have to capitalize your bank in order to have access to money to put to work.
Let's use the example we used in another podcast about your son's shoes. He had shoes too big and he wasn't filling them, right? Those shoes are not going to work in that basketball game. He's going to foul the ball or he's going to travel the
He'll
ball.
look cool doing it, but yes.
Yeah. He thinks he'll look cool doing it.
He does.
But his shoes were too big. Your policy structure was not correct if you're not filling it up. You're not maxing it out. You're not capitalizing it to its fullest potential. And so we don't structure policies the way we do for you to fund them minimum. Funding a policy at a minimum level is truly, life is really bad. Like shit hit the fan and we are in COVID times again and money is not there. Because here's the thing, and I'm just going to use this as an example. I have a client that said, Mary Jo, I can't pay our full premium because we are going on a cruise. I said, what? Why didn't you pay the premium and then borrow against the cash value to go on the cruise? Like, what? So what's happening is we have a policy and we're like, oh, we can pay this after all of our other expenses are paid. And one of our expenses just happens to be that we bought a new car with cash. Oh, what? What'd you do? You bought your kid a car with cash or you bought yourself a new car with cash. That cash could have went through the policy and then you could have borrowed against it, right? Well, I don't want to make a payment. You're making a payment anyway. Making a payment one way or another. So the only time you should ever be paying minimum premium is absolute everything has come to an end. I don't care. It really, and if you are uncertain, oh, I don't know if I can pay full premium. Why are we not calling your agent? Why are you not calling Tarisa or I and saying, hey, what do we do? What do we do? If you're listening to this and John is your agent, why aren't you calling John and saying, John, what do I do? So that we can run those strategies and get you thinking correctly again. Because we've lost the thought process. We lost it.
Yes. But I love what you said. It's pay the policy first. Like to me, that's my version of paying myself. It's like, I want to pay myself first. I am my best asset. And so as a family, as a household, we run it like a business. It's like, okay, well, our goal is this amount in premium every single month. And we pay that first. We make sure that gets done first because most people look at the pie and they segment it because that's how we're taught to think about money. Everything is compartmentalized. So it's like if you're looking at a pie, it's like, okay, this piece is for vacation. This piece is for investments. This piece is for braces. But actually, that whole pie exists of dollars. And those dollars, you want to capture the earning potential of them. So the whole pie is really up for grabs to go in your policy. You have to do that sustainably over time. But I think it's not an either or thing. It's not an additional expense. It's like, no, put that money there first so it can grow for you and then use it for what you're already going to use it for and then pay yourself back because you have to have a primary residence for your money. The policy is the best place for that, right? We do the same thing in our bank account. We save money in our bank account and then we use it for expenses and then we put money right back. Well, your policy should be viewed in the exact same way.
Yeah. It's just one pool of money.
Yeah.
Money must flow.
It must.
Nelson talks about it all. I mean, we're not inventing anything new over here.
We're revolutionaries, Mary Jo.
All right, guys. Comments, questions, concerns, you know the routine. Mary Jo at Without the Bank or Tarisa at Without the Bank. If you need to schedule an appointment, you can schedule an appointment with either one of us. If you've not gotten Life Without the Bank and BYOB, go to withoutthebank.com, grab your book, schedule your appointment, and we are happy to help. You have a fantastic rest of your day.